FedEx shares are under pressure despite the transport giant beating analyst earnings forecast last night. The company's founder, Fred Smith, warned about the labor shortage and vowed to hike CapEx spending moving forward to help support the company's growth. Allison Poliniak-Cusic is a senior analyst at Wells Fargo and covers FedEx. Allison, good to see you on this Friday. How concerned are you about what Fred Smith was saying in terms of the labor shortage? And do you think because of it, FedEx won't be able to meet peak demand levels?
Hi, well, thanks. First, thanks for having me, Brian. And I would say that the labor issue isn't unique to FedEx. It's been a pretty pervasive as we talk to companies across the industrial platform. I think there is some level of optimism that starts to ease in the second half. They're working towards that. And I would say it's not just, through rising prices, it's working to leverage their network more efficiently. All areas on fire to try to improve their productivity in the face of these labor challenges here.
And of course, Allison, it's not just the labor challenges, it's also just capacity, other types of capacity all through their operations, right? Whether it comes to warehouses, whether it comes to trucks, planes, et cetera, et cetera. And they've said they're going to boost spending to address that. Is their spending plan adequate? Do you think that they're doing the right thing and deploying it as strategically as they need to be?
Yeah, I would say on the capital spending, consistent 22 capital spending will be about 8% of sales. So in that range that they target, they noted half of that will be tied to those capacity expansions, increased automation, infrastructure, so forth. So to enable them to handle that increase in volume. E-commerce structurally stepped up during the COVID pandemic and still is at elevated levels. And it doesn't appear that's abating anytime soon. And the forecasts are for it to continue to grow over the next 5 years. So they're incrementally adding capacity. That's certainly the right thing to do. Automation is going to be incredibly important in terms of increasing that throughput and time in transit for them as well.
Allison, I'm sure you picked up on this. So on the earnings call last night, the company said it is the new, quote, the new normal that peak surcharges are going to be here. From a consumer standpoint, I don't want to pay any more for deliveries. I think a lot of the deliveries are in fact high as they are. But from an analyst standpoint, is that a good thing that FedEx really has endless pricing power?
Well, I would say it's not just FedEx, right? It's across the transport networks. Capacity certainly has been well documented in terms of the limitations here. And it's really giving them the capability of, fine-tuning that lens, improving revenue quality. Is that next package that's going on your network? Is that the package you want? And is it being priced appropriately for the cost that you're taking in? So I would say from your perspective, those shipping costs will remain elevated, at least for the next 12 months, in our view.
Well, and it's also, are you getting what you pay for? I mean, if you look at FedEx's on-time performance, I was seeing some stats that it's 88% versus above 95% for UPS. And I can say on an anecdotal basis that I have had issues with some of my FedEx executed deliveries. Are they doing enough on that front? Is that a labor problem? And if it's a labor problem, why are they having the labor problem and say UPS isn't?
Well, I would say it's kind of going back to that next package that you want on your network. And that's something that they talked about addressing going forward here. It's something that they recognize has been a problem with their network. It's really now focusing on pushing back a little bit on shippers. And I think we've seen some of that come through in terms of, you're clogging our networks. Maybe we're not getting appropriately compensated for that. So let's kind of push, re-optimize. I think there's been some news over the past few weeks about that. FedEx sort of starting to push back a little bit on shippers and saying, we need to sort out the operations. Our system's getting overloaded here. Hence the reason for the capacity additions going forward.
It is interesting to see the market reaction. About 2 weeks ago, Allison, we had the UPS had its big investor day. The stock got hit. Maybe the market didn't like its longer-term operating margin guidance here. At FedEx earnings, the stock gets hit. Which stock is the better one to own?
At this point in the cycle, we're looking at FedEx over UPS right now. Today, as we noted in our note, we'd be buyers on the weakness this morning.
Lastly, too, there are a lot of hands, a lot of cooks in the kitchen on these FedEx earnings calls. Is there any signs or indications on when founder Fred Smith might hand off the leadership baton?
Yeah, I mean, to you and I both, I'm not quite sure, but it would certainly be up to him and the board to decide. But at some point, yes, I would imagine he would step aside here.
All right, we'll leave it there. Allison Poliniak-Cusic, Senior Analyst at Wells Fargo, who covers FedEx. Good to see you this morning. Have a great weekend.
Welcome back to Yahoo Finance Live. In today's Crypto Corner, revisiting the largest ever deal in the crypto space. That would be Galaxy Digital paying more than $1 billion to acquire, in a cash and stock deal, BitGo, which originally started out as a digital assets custodian service before expanding into a slew of other areas, including prime lending, trading, and portfolio management as well. And for more on what the deal unlocks and some other questions here on the state of crypto as we're seeing institutional investors continue to move into the space, I want to bring on the CEO of BitGo, Mike Belshe, joins us here for more on all those things. And Mike, I suppose, as we're waiting for this deal to close with Galaxy later on this year, talk to me about what the combination unlocks and how this combination of BitGo and Galaxy really helps both companies build on what they're trying to do.
Sure. By the way, thank you for having me on the show here. Good to see you again. So BitGo and Galaxy, I think together represent the single largest institutional player, in the space. We both have had a common mission, for quite some time around helping make the ecosystem grow by making sure that institutions can participate. And just for those that may not think about this a lot, there's a big difference in how you participate if you have a fiduciary responsibility to your clients than if you're participating as an individual. So the digital asset markets have had strength in the retail sector for quite some time. Obviously, Coinbase has done very well there. But on the institutional side, the needs are very different. Everything from how you secure it, how you manage it, how you audit it, how you run it, how you put backups and insurance in place. These are all different. So Galaxy and BitGo together create quite a formidable strength. Galaxy, obviously, tremendous background from the financial markets, a lot of depth there. Institutional investors are looking for, sure, how do you participate in a long fashion, but how also do you work the risk of that? How do you participate with the derivatives markets in addition to your long positions? How do you trade in and out in a safe and clean way? How do you manage your taxes, your reporting, all that? So with Galaxy and BitGo, we've got a tremendous amount of technology plus financial services strength.
Well, we finally saw last year, institutional money surpassing that on the retail side. And obviously, as Mike Novogratz, your compadre there, has kind of pointed out, institutional money coming back into the space is going to be what's needed to get back to those all-time highs when it comes to Bitcoin. So, what are you seeing right now in terms of institutional demand? Maybe some of those concerns, the security is always top of mind. How do you guys at BitGo maybe address some of those and how they shifted as we've moved farther and farther along in this cycle?
Well, first off, the institutional markets may be slowing a little bit as some of the current macro environment changes are being discussed. But the overall long-term interest, the value proposition of Bitcoin digital assets hasn't changed at all. And so the continued investment from institutions, we're expecting it to fully come. On the security side, we started working on this problem way back in 2013. We pioneered multi-signature technology. We've applied a tremendous amount of operational control as well as technology to everything that we do. Ultimately, it's a matter of security that does come to play. And so we've mostly solved that problem. Now, what we're working on is a little bit of how do you address kind of the market structure? Digital assets emerged early on as a relatively simple market structure with monolith exchanges taking on kind of all functions of the industry. And BitGo has built a qualified custodian. We're chartered actually in 2 states, both South Dakota and New York, and growing that regulatory footprint. But it's really starting to tease apart the storage and security of assets from trading in a very safe way. The institutional investors can have confidence that they won't have single counterparty risk on any one entity.
Mike, we've seen some big sell-offs in the crypto space recently on the back of those headlines coming out of China, crackdown on mining, but also the PBOC stepping in to try and close some of the loopholes that are still existing in the market. How do you make sense of the volatility on the back of that? And ultimately, do you see that as a healthy shakedown?
Well, it's kind of ironic. A few years ago, the complaint about Bitcoin is that, too much of it is controlled by miners in China, then nobody knows who they are. Then the next complaint is that there's too much, non-green energy, coal consumption supporting those miners also in China. Now here we have actually some fantastic news, which is both of those problems are being solved in one shot. I actually somewhat have some sympathy to the Chinese people who unfortunately are being at least temporarily, somewhat locked out of Bitcoin. I think that will change over time. Some of the other questions that China needs, I guess, in order to be comfortable with Bitcoin for their citizens have yet to be answered. But for the rest of the world that isn't operating under such restrictions on their investments, this is actually great news. The energy side of Bitcoin mining just got a heck of a lot better. And on top of that, you no longer have the worries about what could a centralized government potentially do. So we're going to find out that Bitcoin is very decentralized, that it operates just fine, even if a single government decides that they want to try to ban it.
Yeah, and Mike, lastly here, I mean, we talk so much, we flashed that screen, that chart of the growth of DeFi. It's been interesting to see kind of some of these cross-chain entities pop up, Uniswap, and obviously kind of the way that you guys help out. BitGo serves as the sole custodian for Bitcoin that people deposit and then want to move it over to the Ethereum blockchain in a process called wrapping. But there are other institutions out there, other projects kind of dedicated to the idea of cross-chain transactions. I mean, how do you see that space growing if there's maybe unique risks to DeFi you're seeing right now, or what the future looks like there?
Well, DeFi is a little bit more on the front cutting edge of digital asset technology. Obviously, it's only a few years old relative to like Bitcoin that's been around for over a decade now. So some of the use cases that you have with store value on Bitcoin, very safe, very well understood. DeFi is the fantastic emergence of innovation in financial services. So we are seeing a change now where you can automate market makers. You can have completely cryptographic, trustless loans done between parties. These are harder products to build, and they are emerging. In terms of what BitGo does with the Wrap Bitcoin product, it's about helping have large amounts of value participate in those DeFi markets in a safe way. As we get the ability to do this cross-chain, the need for those wrappers may go away. And that's one of the great things about technology is it keeps getting better. So I wouldn't say that Wrap Bitcoin, although that's the product that we put to market, I think it's been tremendously helpful for having DeFi grow. It's not the be all and end all of the technology. We're going to continue to shift with that. We will be participating with on-chain atomic swaps between different chains, and that'll make these products even better, more decentralized, and safer.
Yeah, interesting to see how these solutions in the short term have evolved to become longer term solutions, but we'll be watching as the deal closes. BitGo gets morphed into Galaxy Digital there. But Mike Belshe, the CEO of BitGo, appreciate you taking the time here to chat with us again. Be well.
Well, the bipartisan infrastructure deal that was announced yesterday left out some key climate initiatives that were included in the president's initial proposal. Among them, the establishment of a national clean energy standard. Our next guest has introduced legislation to increase solar energy manufacturing in the U.S. through tax credits. Let's bring in Democratic Senator Jon Ossoff from Georgia. Great to have you on today, Senator. We're going to get to that bill in just a bit, but given the headlines that have come out of Washington over the last 24 hours, I'd love to just get your take on what has emerged here. We're talking essentially a $1.2 trillion deal that is now on the table. Is that something that you would support without the budget reconciliation bill, or do they have to move in tandem to get your support?
Look, first, I want to congratulate the Senate negotiators and the White House on the progress that they've made achieving a bipartisan agreement and the kind of historic investment that we need to see in transit, in transportation, in clean energy, in accelerating the transition from fossil fuel combustion to renewables is going to require historic investment. This bipartisan deal is one component of what's going to need to be a broader and more ambitious effort to accelerate the transition to clean energy and to make long deferred investments in the construction and maintenance of U.S. infrastructure. The civil engineers, for example, estimate that we are $2.6 trillion behind the curve on construction and maintenance of U.S. infrastructure. And we have the opportunity now to govern, to assert American vision and American strength, to make up for lost time. We've been kicking the can on this for too long. So it needs to be an ambitious plan for infrastructure and clean energy. And this bipartisan aspect is one component of that plan.
As it relates to clean energy, when you look at things that are not included in this particular bill, how do you prioritize the initiatives that you'd like to see in the budget reconciliation bill? Would it be about tax incentives to speed up electrification, make homes more efficient? I mean, there's a long list of things that were included in the president's proposal that were omitted from this bipartisan deal.
Well, Akiko, the good news is that the steps that we need to take are not mysterious. As you pointed out, energy efficiency is a key component. Electrification at the enterprise level and the household level is a key component. A rapid transition to electric vehicle adoption and production is a key component. And on that note, Georgia hosts the SK Innovation Electric Vehicle Battery Plant, the largest foreign direct investment in Georgia's history, which was threatened by a trade dispute that I was able to work with President Biden to resolve so that American auto manufacturers will have a diversified supply of the heavy lithium-ion batteries necessary to produce electric vehicles. And we need to invest in scaling rapidly domestic production of clean energy technology. That's why I introduced legislation this week to establish a manufacturing tax credit at all stages of the solar supply chain that will help us onshore the solar supply chain, which is currently dominated by China. China, for the last 15 years, has been heavily subsidizing solar technological development and production with little in the way of a robust response from the United States. It is an environmental imperative, an economic imperative, and a national security imperative that we be energy independent and that the United States have the capacity to produce all of the technology necessary to accelerate this transition to clean energy.
Yeah, it's interesting to see kind of that push. I mean, obviously, you there in Georgia have a couple plants of note, including the largest solar panel manufacturing site in the Western Hemisphere, and it's a big push. Voters there, too, in Georgia seem to be catching up in terms of the amount of people that believe climate change is happening and also that are worried about it, similar to the national polling averages as well. I mean, how important, though, is it to invest now to catch up to China, and how quickly do you think it can happen if this bill is passed to really put us on equal grounds to compete on price?
It's essential because we have been, just as we've deferred investment in the construction and maintenance of infrastructure, we have for too long deferred the kind of definitive investment that we need in American manufacturing of clean energy technology. And that's why this is a refundable tax credit. This is going to allow companies to front load capital expenditures, to rapidly scale production, get those lines working so that American products are flowing not just to all the applications of the United States, but also to the massively growing export markets. This transition to clean energy is happening. It's necessary. The science is definitive. And with this transition, demand for products like solar panels and solar modules is going to continue to grow exponentially. The United States needs to be a key player in the production of this technology. We can't allow China to monopolize this market. And this solar manufacturing tax credit is a key part of that initiative. You mentioned Georgia. Little known fact, the state of Georgia hosts the largest solar module manufacturing facility in the Western Hemisphere. And when I ran for the Senate, I said I want to make Georgia the national leader in clean energy production and technology, and the United States the world leader in clean energy. The legislation that I introduced is intended to do just that. It is estimated it will create tens of thousands of jobs in the solar sector across the United States.
Senator, when you look at the numbers in the supply chain here, when we're talking about solar, it does point to a huge hurdle that you could face in trying to bring manufacturing back to the U.S. About 80% of components, when you talk about the global picture here, is in China. How much of that market share you think you can get back through these tax credits, through these incentives? And what kind of timeline are you looking at?
The United States can regain significant market share over the next 4 to 8 years. We cannot allow this supply chain to be so dominated by a single source, especially when energy production is not just an economic and environmental imperative, it's a national security issue. We used to talk all the time about energy independence in the fossil fuel context. We also need to be thinking about energy independence in the renewables context. And I worked with the White House and the Department of Energy and leaders in the industry to value this tax credit such that on a price per unit basis at every stage of the solar supply chain, from polysilicon to ingots to wafers to modules, the United States will be competitive or at an advantage on a price per unit basis against Chinese manufacturers and other foreign competitors.
What kind of support do you have? How confident are you that this can pass? And is there a potential opportunity here to gain momentum on this bill now that we've got what was a big climate-focused infrastructure bill sort of broken down into pieces now?
There's a lot of momentum. And my objective is to work closely with Senator Ron Wyden, who chairs the Finance Committee, to fold this solar manufacturing tax credit into the overall infrastructure and clean energy proposal. I am actively seeking Republican colleagues who would also support this proposal. I have Republican colleagues with significant solar manufacturing facilities or planned investments in their states. And this is really not a partisan issue. This is an American issue. This is about American leadership, American competitiveness, and the United States is poised. We have the technology, we have the workforce, we have the deep capital markets, we have the market economy such that we can rapidly scale our production of solar technology and other renewables. If we have the incentives aligned properly, we take it seriously, and we unite to get it done.
And how many jobs do you think you can create through this? I mean, you've really pitched this as part of a job creation bill. What kind of number are you looking at?
Well, working with industry experts in the Department of Energy, my assessment is that we can create between 20 and 60,000 jobs in solar manufacturing alone over the next 10 years. And then there's a knock-on effect, which is all the installation, the racks, all of the adjacent economic activity that will blossom as more and more of this technology is installed. So it's a major job creation opportunity for the United States. And I want to emphasize again, Georgia is the national leader in the production of solar modules. Georgia is the hemispheric leader in the production of solar modules. That facility in Dalton, Georgia, again, the largest solar module plant in the Western Hemisphere. This is a huge economic opportunity for my state.
Senator, just lastly, I mean, just to follow on Georgia, it's also become the epicenter of what has become a rather important issue for Americans. That would be the issue of voting rights. And now we're seeing the DOJ coming out and suing Georgia over some of those restrictions. I mean, you had a front row seat for some of this playing out. Obviously, there are a lot of people out there who would say the defense of voting rights in Georgia enabled you to win out there. It seems like an important issue, but we saw earlier this week the For the People Act failing to move forward. And you have Senate Minority Leader Mitch McConnell talking about how this is, as he calls it, one of the biggest lies in politics, that states are working to suppress the vote. I mean, why is he wrong? And why do you need more protections for voters out there? What's the biggest issue you're seeing right now?
Well, look, first of all, this is a story as old as the South. And one of the most threatening aspects of this current voter suppression push is that it's not limited to the South. It's a national effort by Republican-dominated state legislatures to nudge election law in a direction that gives them a partisan advantage. That's why Republican state legislators in Georgia slashed opportunities for early voting and runoff elections. It's why they've made it so much more arduous for seniors, for example, to participate in voting by mail, despite not a shred of evidence that there was abuse of voting by mail. It's why they've given partisan state officials the authority to take over local election boards. Think about how dangerous that is. We just had a situation where the former president of the United States was threatening Georgia's Republican Secretary of State, threatening criminal prosecution if he didn't break the law to, quote, find the votes. That was President Trump's quote, to push Trump over the top in Georgia, despite the fact that he lost. So it is very, very dangerous that state legislatures are passing these bills based on lies about election fraud with clear partisan intent. Under Article 1, Section 4 of the Constitution, the U.S. Congress has the authority to regulate how federal elections are held, and we must pass voting rights legislation to secure the franchise for every American citizen.
Georgia Senator Jon Ossoff, appreciate you taking the time here to chat with us today. We'll see how the progress goes on all those initiatives. Hope to have you back on soon. Be well.
All right, let's talk more about the business of pets. Our next guest turned an Instagram account that posts cute pictures of dogs. I've tried to get my dog Titan onto the Instagram page into a profitable business that is also now giving back. We're joined now by Matt Nelson, founder of WeRateDogs. And Matt, I had to mention that in case you want to post Titan somehow later on. I've now pressured you into it. So
Yeah.
Matt, how did We Rate Dogs really, come to be? And when did you realize that it could actually be just more than an Instagram page, but really a profitable business?
Yeah, so really it started with me being on Twitter and using it as a creative outlet. Like I wrote jokes and found a community of writers trying to do the same thing. And then I've always loved dogs. I soon realized that my jokes that had to do with dogs or even showcasing my own dogs did really well. And so when I was a bored college freshman, I started We Rate Dogs and had about 10,000 followers on my personal account to market it to. And it just blew up immediately. It was like the perfect storm that Twitter must have been waiting for.
So you did so well, Matt, that you actually left school, right? I don't think you graduated college because you were already making six figures with with this app. So tell me how you decided to monetize what you had there as a freshman.
Of course. So initially, it was obviously to it was just to make people smile, and then it soon became we experimented with making some stickers in an e-commerce store based on some of the more popular posts, and people really embraced that. And then it's probably a year after the account started that we made a full e-commerce store with like the best phrases and things from the account that people really loved. And so that's how the audience kind of embraced that initial attempt to monetize. And then soon we realized that our community was way more powerful than just liking and retweeting dog photos. And we kind of pivoted to these GoFundMes that we do every Friday.
So talk to us a little bit more about that, because I've seen, and I actually do follow your page and your account, so I was very excited to chat with you today. And I've just noticed the ability of you guys to essentially crowdsource money and funding to really help a lot of dogs that have gotten injured, to really talk about pet insurance and other things. So talk to us a little bit about that component of giving back, how much money you guys have been able to raise and to give out to other dog owners, and what's next really in terms of giving back to the pet owner community.
So to date, and we really started this GoFundMe effort with the first Friday of 2017. So in those 4 years or so, we've raised over $1.6 million and have been able to help hundreds of dogs, which is amazing. I'm not sure how I curated a community that is so empathetic and passionate about dogs, but it's been wonderful to see. And yeah, every Friday. And so these are mostly for dogs that need unexpected surgery or treatment. And that can range from $4,000 to $20,000. Pet healthcare is very, very expensive. So, but my audience sees that goal. They understand how GoFundMe is gamified, and we try to gamify it even more. And we're able to raise that money in minutes. I think we've raised upwards of $10,000 in 15 minutes before. It's really something to watch unfold. And we have a new partnership with Trupanion, which is medical insurance for cats and dogs. And because we've been so consistent with these GoFundMes, it's easy for us to pivot and say, hey guys, we would love to be sent less of these GoFundMes. So please consider pet insurance, because in most cases, it can alleviate some of this financial burden. So again, thanks to our partnership with Trupanion, every Friday, we're able to fund a second dog ourselves. We Rate Dogs covers the bill for someone. And instead of asking our entire audience to crowdfund this dog, I just tell them to please consider pet insurance so that you're not in a predicament where we would have to post your dog.
Matt, of course, this is all a part of our, business of pets, of course, because today is Bring Your Dog to Work Day. Mine decided to sleep instead of join me here for this interview. But curious to know, because we were just showing some figures, some stats right there on how much money is really being spent on dogs, but also cats and other pets. I'm curious to know, especially after the year like the one that we just had, how much you see pet owners really just spending more money or expanding into pet ownership. Where do you see this industry going since you started it?
So it's been wild to behold, like the growing love for dogs and treating them more and more like a member of your family is, as a dog lover, it's amazing to see. And so I think that number will continue to increase as they're treated more and more like a member of your family. And as people have less kids, like dogs are considered, for a lot of people, their children. So I think that that'll continue to grow, and hopefully it'll grow in a responsible way. During the pandemic, we were inundated with pandemic puppy submissions from people that had more time on their hands and went and got a puppy. And we hope that our community is not the type to return those dogs once they have to go back to work or return to their normal lives. But that has been, unfortunately, a trend that we've seen, and just hoping that at least the members of our community have been responsible in that choice and actually do treat them like their family, and aren't making that return as soon as life goes back to normal.
Well, you definitely honed in on something here, Matt. And I'm just curious if other companies in this space have come to you with buyout offers, or they want to sort of envelop your brand into theirs for We Rate Dogs. Have you gotten those sort of inquiries, and do you entertain them?
We do entertain them. I think that it's still my baby, and I love the creation. They're the creative part of it so much that it'd be hard to give away. But with partnerships like Trupanion, and then we also have a long-term partnership with Just Food for Dogs, which is a pet food company. I think with those partnerships, it's allowed us to kind of be a little bit more independent with our creative, and having like those two choices are very, very aligned with our mission of just celebrating dogs in general. I think that having pet insurance and feeding your dog a quality food are what helps you celebrate them and help them live longer. And so those very purposeful partnerships are not made by accident. And I think we're looking forward to continuing to create a community that loves their dogs and does what they can to make them happy.
All right, Matt Nelson, founder of We Rate Dogs. Thank you so much for joining us, but also for bringing the world just a ton of cute dogs for us to all look at.
Yahoo Finance's Brian Cheung joins us now with one of those policymakers to learn more about what may be next for the Fed. Brian?
Thanks so much, Alexis. Well, joining us now here on Yahoo Finance is the president of the Federal Reserve Bank of Boston, Eric Rosengren. It's great to see you, President Rosengren. I want to kick off our conversation, as Alexis was saying, a lot of eyes are on the Federal Reserve policymakers, but want you to respond specifically to this morning's inflation numbers from the Bureau of Economic Analysis showing that core inflation rose by 3.4% year over year. That is the highest reading that we've gotten since 1992. Just wondering how you're parsing through this morning's report.
Yeah, as you highlight, the number that came in was 3.4 for the core and 3.9 for the total. So core inflation was going up. It's not a complete surprise. I do believe that this is likely to be transitory. And the reason I think that is for a number of reasons. If you looked at the trim mean PCE, it's at 1.8%, so it's substantially lower. What the trim mean does is it takes out the large movements at both ends of the distribution. But if you look at private sector forecasters, they're expecting, if you use something like the Survey of Professional Forecasters, they're expecting core inflation next year to be 2%. I'm expecting it'll be slightly higher than that. You're seeing a Treasury 10-year that's trading at 1.5% roughly. All that is consistent with inflation going up right now as a result both of repricing relative to where we were in the pandemic, and is also reflective of the fact that there are a lot of shortages. Real GDP is growing quite quickly. We're expecting roughly 7% growth over the course of this year. With that kind of growth, and it's a bit of a surprise that we've been able to open up as quickly as we have. I think it's not unexpected that we would see some supply shortages, and indeed, that's exactly what we're seeing. If you look at something like used car prices that are up quite dramatically over the last few months, that's not something that's likely to persist. Eventually, we will have chips that are going to be produced, and people will start buying new cars instead of used cars, and I would expect those prices to come down. Similarly, planes, hotels, rental car, all those prices are up, but they're up relative to very low levels during the pandemic. So I expect that there will be a surge in prices that we've been seeing this spring. It'll continue maybe a little longer than we were expecting, but I think the best guess going forward is that when we get into next year, we're going to be seeing inflation just barely above 2%, very consistent with the private forecasters.
So, President Rosengren, can we expand a bit on your economic forecast? You said that your projection is for 7%, but I don't know if you're speaking about the FOMC's median projection from last week, but where do you, based off of what you're seeing in the Boston Fed, have GDP, inflation, employment over the now to 2023 time period?
My own view is pretty close on inflation to what the median was for the summary of economic projections at the June FOMC. So I'm expecting inflation to be a little bit above 2%. I am expecting that the unemployment rate, which is currently 5.8%, is going to decline quite significantly over the course of this year, likely to be in the mid fours by the end of the year, and arguably at full employment as we get into next year. So I think there's likelihood of very good progress on the labor markets. That being said, currently we have 5.8% unemployment. If you look at the labor force participation rate or the employment to population ratio, we're still well below where we were in February of 2020. So there's still a lot of labor market slack now. I do think that if we get the growth that we're expecting, that that will be less of the case as we get into next year.
So based off of those projections, do you expect, first of all, inflation to be only just a nudge above 2% because of some reaction from the Federal Reserve? There's been a lot of chatter about the 7 of the 18 members that have a rate hike penciled in for 2022 and 13 of the 18, at least one rate hike through the end of 2023. Where are you in that timeline?
I mean, it really depends on what the economic outcome is when we start raising short-term interest rates. So the criteria is that we have a sustainable inflation rate that's 2% or above, and that we're at full employment. I do expect that it's quite possible that we will see that by the end of next year. But it does depend on whether the economy progresses as strongly as I'm expecting. So we'll have to see if that's the actual outcome. But it wouldn't surprise me based on the current projections of what we're seeing in the data that that criteria could be met as soon as the end of next year.
So does that mean that you did have one rate hike penciled in for the end of next year?
Yeah, I don't talk about my specific forecast, but I will say that it's quite possible that the conditions that were laid out in the statement will be met around the end of next year if we get the kind of growth that we're expecting.
Got it. Well, it was worth a shot anyway. But I want to expand a bit on the labor side of things. You did touch on it. Where do you see full employment, or when do you see us reaching full employment? And then as a secondary question, because this is arguably more important, do you think that the definition of full employment in the post-pandemic economy is different than full employment as you saw it in the pre-pandemic economy?
Yeah, I think determining full employment right now is pretty difficult. And part of it is because the main driver of this recession was the pandemic and concerns about personal health. So we know that both employment to population and labor force participation are much lower than they were in February 2020. I think a big question is whether those people are going to be willing to come back into the labor market, particularly in job positions where they may have a lot of contact with people where they may not know whether they're vaccinated or not. So think of somebody who works in a hotel or somebody who works at a restaurant. There may be people that are concerned about their own personal safety, or they may be concerned that they have young children. They don't want to put them in childcare right now. And as a result, they're pulling out of the labor force. So it's going to take some time to figure out exactly why we have so much labor market slack and how much of it's related to public health concerns and childcare concerns, and how much is related to other concerns. So I think the one way we observe that is whether wages and prices start picking up substantially. Obviously, prices are quite high for other reasons right now. But if we start seeing inflation numbers that are much higher next year and wages going much higher next year for the overall labor market, then that is something that we're going to have to pay attention to. Right now, that's not my expectation, but I think we have in our historical data post-World War II, we don't have a serious pandemic in that data. So we don't know exactly how the opening up is going to occur. And I think we have to be pretty humble about what's going to happen with inflation and labor markets. This is going to be a time where we should be particularly data-driven.
Yeah, well, as you point out, the recovery pace is at a speed we've never seen before, so it's kind of hard to catch a breath in terms of how everything is going. But I guess that raises the question of, is there a risk of a trade-off if, for example, the recovery in price levels is happening at a faster pace than the recovery in employment levels? Does that maybe threaten the possibility of the Fed, again, tightening to quell inflation before the labor market has had the ample opportunity to heal?
we've made clear that we're not going to raise short-term interest rates until we think we're at full employment. So our framework is basically going to keep us from doing that. But I do think we have to be sensitive to what's happening with inflation, and measuring full employment is not straightforward, as I just mentioned. So we look at both inflation and unemployment and a variety of other indicators when determining what's appropriate monetary policy, and that's going to be what we do as we continue to see how the data gets revealed.
Welcome back to Yahoo Finance. I'm Brian Cheung, here with a conversation with Boston Fed President Eric Rosengren. And President Rosengren, we were talking about monetary policy. I want to kind of just switch gears real quick to another newsy item that people have been watching, the Biden agreement for an infrastructure package that could total $1.2 trillion. I guess from your vantage point, what might be the impact of that, especially given the concerns about maybe an overheating economy?
Well, first of all, we don't actually have a signed bill yet, so we'll see if the actual bill gets signed and what it's paired with. But fiscal policy is highly stimulative, as you've highlighted. That is one of the reasons why we're expecting such strong growth. So it's a bit unusual to have a coordinated, very low period of interest rates at the same time that we're getting so much fiscal stimulus. That is one of the reasons we're expecting to get back towards full employment at the end of this year, beginning of next year. And so I'm very supportive of the fiscal policy we're doing. I do think at some point we're going to have to be thinking about how to financing that. Certainly when we get back to full employment and if inflation's around 2%, just as monetary policy has to normalize, so does fiscal policy.
Now, I want to switch gears to financial stability. You just had a pretty in-depth conversation at the OMFIF about a number of stability risks that you're watching. But people forget that the Federal Reserve is not only watching their proximity to maximum employment and also price stability, but also making sure that there's no bubbles popping up in the financial system. And you did call out home prices as one possible area. Wondering if you could elaborate a little bit more about the rising home prices that you're seeing in the Boston area where you sit, and whether or not that could present some sort of financial stability risk.
Yeah, my concern about housing prices is not just because prices are going up in the Boston area. It's really because prices are going up across the country. And I think you're also seeing price increases that are going up rapidly in less traditional places. More rural areas of Maine, Western Massachusetts are places where real estate prices normally are not going up rapidly. So it's not just in the cities like Boston that we're seeing it. We're seeing it in the outlying areas as well. Now, that's not to say that I think that it's an immediate problem, but in that talk, I did have a chart that highlighted across a wide variety of markets, housing prices have been going up. In many of those markets, it's already higher than it was in the 2005 to 2007 period. And I would highlight that over the last 3 or 4 months, at least in some markets, the steepness of how much prices have been going up is quite similar to what we were seeing in the 2005 to 2007 period. The reason I focus on housing prices and real estate prices generally is because it's a widely held asset and has tended to result in financial stability problems in many of our worst recessions. So think about the financial crisis or the Great Depression in the United States. But if you look at financial stability problems around the world, they tend to be tied to real estate. So I think it's an area that bears monitoring. It's not at the point where we should be panicked. It's not at a point where we should be overly concerned. But if this were to continue and if it was starting to get embedded in people's expectations for where prices would be going, that would start to become a more significant concern. The last thing we want to do is to try to get to full employment and then unintentionally cause a boom and bust in the housing sector that prevents us from getting to full employment or staying at full employment. So I think that is one of the many areas of financial stability that we have to keep our eyes on as we think about keeping interest rates low in order to meet our inflation and unemployment objectives.
Well, I guess a natural question might be, is the Fed's purchases of agency mortgage-backed securities, it's buying about $40 billion a month as part of its quantitative easing program, feeding into what you're seeing? And if so, does that make a case for maybe skewing away from mortgage-backed securities at some point when you do decide to start tapering that program?
So our criteria for tapering is substantial further progress. And the question is when we reach that view that we've attained substantial further progress. I think in inflation, we've made substantial further progress. Maybe we've overproduced right now. But on the labor market, I still think there is significant labor market slack. But I do expect that it's going to subside over the course of this year. So I think it's quite likely that the substantial further progress criteria, at least in my own personal view, will likely be met prior to the beginning of next year. And a lot depends on exactly what happens with the economy over the course of the summer and into the fall about when it would be appropriate to actually start the taper. In terms of your direct question on MBS, I mean, we're buying both treasuries and MBS in order to keep long-term interest rates low. I do think that one of the areas that we should consider is that the tapering maybe should be in the same amounts for both the treasury securities and the MBS. As you know, we're purchasing 120 billion overall, 80 billion of treasuries, 40 billion of MBS. If we decrease the same amount of those two when we do start tapering, that would mean we'd stop the MBS program well before we stop the treasury program. These are details, though, that the FOMC has not decided on. So these are just my own personal views. But I do think right now that the spread between MBS and treasuries is quite narrow. And I do think we have to pay attention to the housing sector. So I think that that is one of many considerations that we should include as we think about the substantial further progress.
And then I want to shift lastly here to stablecoins. You were talking about Tether in your presentation actually just about an hour ago. It's been taking a lot of air out of some of these prime money market funds. But you pointed out that Tether and a lot of these other stablecoins are deep in things like commercial paper and even corporate bonds in some cases. But my question is that the Fed did step in during the midst of this pandemic to backstop the corporate debt market and commercial paper markets. So I guess isn't the financial stability risk of those stablecoins like Tether only as big of a risk as the Fed will allow, given its historical role as a backstopper?
The reason I talked about Tether and stablecoins is if you look at their portfolio, it basically looks like a portfolio of a prime money market fund, but maybe riskier. We actually had a stable coin that ran into financial difficulties last week. Tether, as you highlighted, has a number of assets that during the pandemic, the spread got quite wide on those assets. The Fed intervened in order to make sure that short-term credit markets continued to operate. And the reason we should be a bit concerned about stablecoin is that it's growing very rapidly. So there's exponential growth in stablecoin. The prime money market funds have been slowly going down as people have looked for a less risky way to hold their transactions accounts, and many of them have moved to government money market funds. But I do think we need to think more broadly about what could disrupt short-term credit markets over time. And certainly stable coins are one element. I think there are other investment products as well that have the characteristic that if we have a big shock in financial markets, people tend to move out of those areas quite quickly. And I think that's an area of financial stability we need to pay more attention to.
I mean, I guess as a follow-up, though, I guess my point being that if the Fed is going to backstop those markets, if they do experience stress, then wouldn't there not be as big of a financial stability risk from those types of products?
So my own view is that we should be changing the regulatory environment so that we don't have to intervene in the markets every 10 years. And while we ran the MMLF and the AMLF to support short-term credit markets and the money market funds in the last two recessions out of the Boston Fed, I would hope that we would change the regulations so that the next time we have a crisis, we don't have to do it again. And I guess the broader point is that it's not just money market funds that we have to be worried about. We have to be worried about things that destabilize short-term credit markets. That takes a more holistic approach to thinking about financial market regulation. I do worry that the stablecoin market that is currently pretty much unregulated, as it grows and becomes a more important sector of our economy, that we need to take seriously what happens if people run from these type of instruments very quickly. And just like the money market funds caused a bad disruption in credit markets, I think a future financial stability problem could be occurring if we don't start thinking carefully about what happens to things like stable coins next time we have a bad market difficulty.
All right. Well, a lot to chew on there. But again, the Federal Reserve Bank of Boston President Eric Rosengren stopping by Yahoo Finance. And I want to point out, by the way, that we did not call each other to coordinate this outfit today. But thanks again for stopping by here on Yahoo Finance. For right now, we'll toss it back over to you, Kristin.
All right, Brian, thanks so much for bringing us that interview.